independent observers could reach an answer. So it's verifiability. It is directly by the definition. And okay, because I think this class only has two people, two of you. If you have any question, you can directly discuss with me. We can spend more time on the question you get the wrong answer. Hello. Oh, you haven't looked at it because I know the multiple choice question is a test, right? Oh, okay, so yeah, this is our in-course exam. Okay, so because today only three of you comes, I think we can save some time and also like we can spend more time on the question. You really have problems. We don't need generals discuss every question. So could you please tell me like which question you are interested in? So we can spend more time on the question and give you a detailed explain. Wang Tianliang, Jake, and also Shanice, right? Do you have any question? What is a question? What is a question that you get the wrong answer? We can have a focused discuss. So the first question, you are correct, right? And the second, IFR standards usually cover sections on what? No problem. Also, Wang Qianliang and Shanice.
No problem.
No problem. And also, so to solve this question, you need to understand the relation between the conceptual framework, IFRS and ISB, okay? And by the scope of conceptual framework, you can get the correct answer, okay? Also, if you know what is the meaning of accrual accounting and acquisition accounting, you can exclude the wrong answer and get the correct answer C. So question 3, what is the result? So, okay, if you have a question, just tell me, okay? What is the result of recording debt reimbursement? You use cash to pay the debt, so it's decrease of cash and liability. The question 4, what does GAAP stand for? Do you have a question? No, right? Generally accepted accounting principle. And the question 5, how does IAS 37 define contingent liability? Do you have a question on this? No? Also, Jake? Okay. The last student? Shanice? Shanice, are you there? Okay. We keep going. The question 6, an impairment loss occurs when the carrying amount of an asset exceeds the recoverable amount. It's the same, right? By definition, IAS 36.6, impairment loss amount by which carrying amount of assets or cash generating unit exceeds its recoverable amount. So, so you should select the choice B, okay? And fill in the gap. What means having information available to decision maker in time? Blah blah blah. Timeline's right. The question 8, fill in the gap. What means that information can be compared with similar information? Comparability, right? And do you have a question in question 9?
Yes.
Okay. Which system is the best method for matching most recent inventory cost with current revenues? Because following the description, FIFO means first in, first out, and second means last in, first out. Okay, if directly by the description, some of you might think the first in, first out is match the current revenue, but actually it's not. Okay, imagine that by the same inventory, it could bought at the same price. It can be effect of exchange rate, different exchange rate. It can be the market condition. It could be the different exchange rate. So the inventory have different, same inventory might have different price. That is why we need to use some specific method to calculate inventory, and by specific method we can get the different value of the inventory. Like first in first out, there have three methods you have learned: first in first out, last in first out, and weighting average. So let's discuss this. Okay, imagine that so you have imagine the opening inventory is 0, and the first day at January, sorry, the January the 1st, you bought some inventory. You bought 10 units inventory at a cost of 10 pounds. Oh no, okay. The number, so the amount n is equal to 10, and the price is equal to 10. Okay, and also at the June 2020. Okay, let's imagine it's 20, because later you will have another two questions to also discuss the same, you know, first in first out, last in first out, average, weighted average. So we can discuss those methods in detail. And the second purchases you made by the 1st June 2020, and because the market fluctuation, the price of the inventory have changed. Let's imagine the inventory is how many tons of iron, okay? So the amount is 10 tons. You bought 10 tons of iron, and the price is 20, okay? The price is equal to 20. This is the last purchases you made, 1st January. This is the first purchases you made, okay? It's in the 2020, okay, January 2020. This is the purchases. So after a year, you have used 15 units of the inventory. So that means there are 5 units of inventory left in your stock. But imagine your inventory is similar. They are both of inventory are iron. So they basically, although you bought those inventory at different price, but this inventory actually have no difference. Okay, so you can't recognize which iron is bought at first purchases or which is bought at the second purchases. So basically, it has no difference, and the cost is 15 units. So because you know, if you summarize, consider the opening inventory is 0, and purchases is equal to 20. The total purchases is equal to 20 units, right? So you know the left amount of inventory is equal to 5 units, right? Now you need to preparing the cost for sale, right? The cost of sale. So how much is the cost of sale by the first in, first out? So although like the iron has no difference, but when you consider when you're calculating the cost of inventory, you can assume it might have a little bit difference, and you can assume it's physically first in, first out. Just imagine, okay, it's first in, first out by physically. So by the first in, first out rule, the first in 10 units should be you know, going to the selling process first. So because the total selling is 15 units, therefore the first purchases 10 units have all been sold, right? So by first in, first out rule, the first purchase, the inventory you bought in first purchases have all been sold, right? Because it only 10 units, and the overall cost of your factory is 15 units during this year. So by first in, first out rule, this 10 units, of course, it has been sold first. Okay, after selling those inventories, we start to sell. We start to sell the inventory we bought at second purchases. Okay, so um, because the overall uh, sold is 15 units, and 10 units have already been sold. So in second purchases, we need to sell another 5 units of inventory, right? So basically, if you imagine that is physical assets, the first purchases, it's all being sold, and second purchases, is sold 5 units. So only 5 units um, of inventory bought in the second purchases have been left in your storage, right? So in your closing inventory of financial statement, what is the total amount? What is the value of inventory? When you're calculating the value of inventory uh, by first in, first out method, so what is the value of inventory? Only 5 units of inventory bought in the second time was left in the storage, right? So you use the price 20 times the the amount of inventory is equal to 5 times 20 is equal to 100. So the value of inventory is equal to the 100. Okay, and imagine the last in first out method. The last in first out. So that means um, if ceteris paribus, if other conditions remain the same, the total cost is 15 units. So for last in, first out. So these 10 units of inventory have been sold first. And after selling the inventory you bought at second time or the last time, and you go back to sell the inventory you bought at the first time, and only sold 5 units of this inventory, and the 5 units have been lefted, right? So the selling is 10 units of inventory you bought at the second time and 5 units of inventory you bought at the first time. So how many inventory you left? You left 5 units of inventory you bought at the first time, right? So it's equal to the price is 10 times the amount is 5. So it's equal to the value of the inventory is equal to 50 pounds. And what is the weighted average? The weighted average is because iron has no difference. Therefore, why we need to calculate them by different prices? We can calculate them by the weighted average cost. So the value of by weighted average methods, we calculate the weighted average price of the inventory. For example, it's equal to 5 plus 10 to the 2. 5 plus 10 divided by the 2 is equal to 7.5. It's equal to 7.5 pounds per unit. And because the total amount is 20 units, and you have sold 15 units, so left 50 units, 5 units, and 5 times the price, 5 times 7.5 is equal to 37.5. This is the value of, no, how could it be? Wait, 10 plus 20 to the divided by 2 is 15, okay? This should be 15, and 15 times 5 is equal to 75. So by the weighted average method, because the average price of inventory is equal to 15 pounds per unit, so the overall left in the storage is 75. Also, by the different method, when you're calculating different depreciation, like in the first method, the depreciation, the first in, first out, the depreciation is equal to, no depreciation. The cost for sale is equal to 10 times 10, 10 times 10 plus 5 times 20. And if it's in the last in, first out method is 10 times 20 plus 5 times 10. So basically, when you're calculating the cost, or when you're calculating the closing inventory by using different method, it get different answer. And this question is asking you, what is the best method for matching most recent inventory cost, right? So matching most recent inventory cost, of course, should be last in, first out, right? Because the most recent cost of the inventory is as a per unit 20, right? So last in, first out is most closing to the recent cost, recent like price of inventory. So we choose the last in, first out method. Okay. And question 10, what does ISB stand for? I think you don't have a question on this. Question 11, Eagle Company has the following information relating to its inventory activities. When we calculating our balance sheet, we have calculated the closing inventory for many times, right? When we're preparing our balance sheet, the closing inventory is equal to the opening inventory plus purchases minus cost of goods, and it's equal to closing inventory, right? So by same formula, you got you can got the correct answer. The cost of goods is equal to 90,000. Also, if you understand the concept of this formula, you can also very easily get the correct answer. Like imagine the opening inventory is 150,000 and closing inventory is 180,000. What does that mean? That means after all the cost, your inventory increased 30,000, right? That means the purchases during this financial period exceed the cost during this financial period for 30,000 pounds, right? Therefore, we know the purchases is 120 and the exceed part is 30,000. So by using the 120 minus 30,000, we can got the cost for sale is equal to the 90,000 pounds. Okay. And question 20. Daniel Ltd, a manufacturing company, has following information related to the sale of its products during 2020 and under accrual basis accounting how much net revenue would be reported on the income statement. This question, some students make the mistake is because they misunderstand the definition of net revenue and net income and net profit. So by definition, net revenue is defined as company sale minus discounts and returns. So in this question, we have no discounts and only returns, 500,000 pounds. We use 5 million minus 500,000 and the net revenue by the definition is equal to 4,500,000. And question 13, the company has the following income statement information. And the question is profit is equal to how much? Gross profit is equal to how much? To calculating gross profit is revenue minus the cost for sale. So it's 5 million minus 2,850,000 is equal to 2,150,000 just by the definition. Okay. And question 14. Company A prepares financial statement to 31st December 2019. During the year, the company spent 350,000 on research and 130,000 on development. The development cost meets the criteria for recognition as an intangible asset and are to be amortized over 3 years, blah, blah, blah. And what is the expense of research and development cost? So the research is not intangible assets, so we regard it as a cost. We calculate it. We calculate the expenditure of research by the value of the cost, right? So it's 350. And the development is regarded as intangible assets. Therefore, the expense is equal to the depreciation um, of the of these assets of the development generated assets, and because it's straight line basis, therefore the depreciation, like imagine development is a kind of intangible assets, and its depreciation is equal to 130 minus 10,000. 10,000 is a residual value of this assets. So 130 minus 10,000 is equals to the total amount that can be depreciated, and times 123 is equal to 123 means represent the the cost um, based on the life of these assets, and the life of these assets is 3 years. So for one financial period, the cost is 123, 1/3, right? So the depreciation of these assets during this financial period is 40,000 pounds, and you use 40,000 pounds plus the cost of research, 350 is equal to 390,000. Okay. Question 15, a vehicle of a motor vehicle dealer at the end of accounting period, blah, blah, blah. So I think we have discussed this question as the first tutorial because before you sold the product to the customer, the selling price is unrealized value of the product. When you calculating, when you're preparing the financial statement by the prudential basis, you should use the cost of this product to represent its value instead of the selling price. So the cost incurred to the date is 500,000 pounds. Sorry, 500 pounds. So the correct answer of this vehicle, of the value of this vehicle in the financial statement is 17,500 pounds. Okay. The question 16. Property industry reported the following amount on its balance sheet on December 31st, blah, blah. And the retained earnings of 2020 is what? To calculate to solve this question, you need to understand the structure of the balance sheet. Okay, the balance sheet is consists by the assets, liability, and equity. Right, retained earning is a part of equity. So you also you understand that assets equal to the liability plus the assets equal to the liability plus debt. The liability plus equity, right? And you first include each item to those categories like cash, current assets, notes payable, current liability, inventory, current assets, ordinary shares is equity, net property, plant, and equipment is non-current assets, account receivable assets, account payable, current liability, right? So after you include all the value into the the structure of financial balance sheet, and you use the total value of assets minus the total value of liability, and it's equal to the value of equity. And you use the value of equity minus ordinary shares to calculate the retained earnings. Okay, because the retained earnings plus ordinary shares is equal to the equity, the value of equity in this question. Okay, and it's equal to 210,000. The question 17, given the following data, what is the amount of ending inventory under the last in first out standard? So we have discussed this just before, and because it's last in first out, we assume, we just in our brain, you imagine it's physically last in first out. You can imagine in real like accounting, it is not physically last in first out. Okay, it is not physically last in first out, but when we solving those questions to help ourselves, we can assume, we can imagine it is physically last in first out. So Second is last in, first out. So this is already being sold because uh, the total cost is 15 units, right? And this is only 10 units, so it's all being sold. And the left-hit infantry, only 4 units we bought at the first time left-hit in our infantry, and because it's 10 pounds per unit, so the value of those storage in our factory is 10 per unit times 5 units is equal to 50. Okay, if it's the same question, if it is first in last out, then first in last out, so this 10 units has been sold, and 5 units of second purchases is left it in our factory. So we use 5 units times 15 pounds per unit, so it's equal to 75, right? 75 pounds. If it is by the first in first out rule. Okay, so the question 18, a provision is a liability that of certain timing or amount, right? This is by the definition. Also, I think previously in the question 7 or 8, we have discussed the definition of let's see. Contingent liability, right? It is very similar concept compared with at what time we should provide a provision. Okay, when the timing and following the definition, when the timing and the amount is uncertain. So there we have discussed. Okay, when the timing and amount is uncertain, so we should provide a provision. So we should select the choice A, right? If this transaction we uncertain about timing, then we should provide a provision. If the amount is uncertain, we should also provide a provision. Okay, but you need to understand what is the meaning of timing. Okay, later we will discuss. Question 19, given the following data, what is the net book value of an asset at the end of year 2? To calculate net book value, we use the initial cost of assets minus the depreciation, right? This is by the formula, and this question gives us some required information to calculate the depreciation. And because it's straight line method, we use the 190 minus 10. 10 is the residual value, 190 is the initial cost. So 190 minus 10 represents the total value that can be depreciated, and times the 2/6. This is a total depreciation for first 2 years, because it is asking us a net book value of an asset at the end of year 2. So for first 2 years, the total depreciation is 2/6. So if we are calculating the depreciation in this financial period, it should be 1/2. Oh, sorry, 1/6. But now we are calculating the depreciation for the first 2 years. So it's 2/6. And the total depreciation is equal to 60. And using the initial cost minus 60, we got 130,000, right? Also, by the straight method, if you want directly calculate the net book value, you can use the total amount of depreciation times the left part of the asset, which is 4/6 plus 10, which is residual value. You can also get the 130, okay? And question 20, given the following data, what is the amount of ending inventory under weighted average cost of method? So by the same standard we have discussed, weighted average cost method, what is the average cost of inventory? So 10 per unit, you bought 10 units, 12 per unit, you bought 10 units. Very simple, you can very easily, you can got that the weighted average cost of the inventory is 11 pounds per unit, right? And you have sold 15 units. Therefore, you have 5 units left in the inventory. You use 5 units left it in the inventory, left it in storage times 11 per unit is equal to 55 units, 55 pounds, right? Basically, what is the selling price? It doesn't matter. And question 21. So this question is very closely linked with our discussion on the question 18. A provision is a liability that of uncertain timing and amount, But why is in question 21, only the company C should not provide a provision? Like the description of company C is that it owns a fleet of motor lorries, all of which required an annual service. This servicing work is expected to occur in the first few months of the year. So when you read the description, you might think that first few months is uncertain timing, right? But why we don't need to provide a provision for this company? Because although the exact date is uncertain, it's unclear, but the timing is not uncertain. The timing is certain. The timing of this transaction will happen in this financial period, right? Because when you're preparing the financial report, you are not preparing a financial report for every minute. You are preparing a financial report for each year or each half year, right? Semi-annually. So for company C, because this cost will happen in the first few months. So no matter your report is provided semi-annually or annually, the cost has a certain timing, right? It will occur before the closing date, right? Therefore, the timing actually is clear if you compare it with a financial period. But imagine if we change the description of this question a little bit, like it is expected to occur at December or next year, January, then we might need to provide a provision, okay? Because we don't know, because at the end date of this financial period, when we preparing the closing account, we are not sure in the next year how many parts of services will occur. So how many, what is the value of services will needed in the next year, okay? So in this question, we should select the A, B, and D. Also, why the question D? Because it looks like the timing and the amount are both clear, right? The timing is this year, and the amount is 375. But why we need to it is because in accounting principle, we assume, right? So this is an unexpected event. Therefore, this is unexpected events. Therefore, we should provide a provision for this account, okay? And for the question 22, during 2020, the net profit of the company, blah, blah, blah. This question is actually asking us to preparing an income statement. And, when you're preparing the income statement by accrual basis, we all know that the revenue is equal to the customers paid or promised to pay. Because if customer paid, in your balance sheet, it will be regarded as an increase of your assets. If the customer are promised to pay, then it will be regarded as an increase of receivable, cash receivable, or trade receivable, right? So no matter it's paid already or it's just promised to pay, it will all be a part of your assets value. So the revenue should be based on 587 instead of 552, okay? And also because of accrual basis, although that you have some money didn't pay to your employees, but this should be included as accounts payable, and it's also a part of your liability. If you already paid, then it's a cost. If you didn't pay, it's an increase of your liability. So you should deduct. You should deduct it when you're preparing the income statement, right? And also minus the interest expense and services, other services expenses to calculate the profit before taxation, right? After this step, after we deduct the interest payment and the other services expenses payment, we got the profit before taxation. And taxation is 20%. So the net profit in income statement should be 27,000 pounds. Okay, 27,200 pounds. Although you need to pay dividend, but how much dividend you paid have no effect on the net profit of your company, right? It only have an effect on the retained earnings. Okay, so by the definition of each item, we know the net profit of the company is equal to 27,200 pounds. This question is asking you, basically it's asking you to preparing the income statement. And also you need to understand what is the relationship between the dividend and net profit, okay? Net profit equals to the dividend plus retained earning, okay? And question 23 is very important. On 1st January 2021, this company enters into a 3-year lease of official machinery. The company is required to make payments of 50,000 pounds at this fall due on 1st January 2021, 2022, and 2023. The rate of interest implicit in the lease is 8% per annum. So what is the total interest in 2022? To solve this question, you need to first solve what is the opening liability when you made this transaction. Okay, what is the opening liability at the 1st January 2021? How to calculate the opening liability? The opening liability, I think you have learned the corporate finance. It's very similar concept with present value. Like imagine the payment. This is 50. This is payment, okay? Payment, and this is 2021. January 2021, okay? January 2021. You get 50,000 pounds payment, and this is 2022. You got 50,000 pounds payment, and 2022, and this is 2023. You got 50,000 pounds payment. So, what is the opening liability of this lease? By the opening liability is equal to the present value of the machinery. So it's equal to 50 plus 50 divided by 1.08 plus 50 divided by 1.08 to the power of 2. And it's equal to 139.12, I think. So that means the opening liability. If we calculate the liability accounts, liability accounts, the opening liability at 1st January is how much? It's equal to 139.12 minus 50, right? Because the opening value, basically the initial value of these assets equal to, present value is equal to 139.12, and you made the first payment at the 1st January, right? So at the same day, in liability accounts, what is the liability accounts? It's equal to the opening value of this machine minus basically the part of liability you have paid 50,000 pounds. So it's equal to 109.12 minus 50. So it's equal to 89.12. This is the opening liability in the 1st January 2021. Okay, so this part of liability will generate an interest cost. Okay, so it's times 0.08. So the interest cost, the interest is equal to the liability times the interest rate, right? R. So it's equal to 89.12 times 0.08. Okay. So what is the opening liability for second year? For second year is that the opening liability at the first year plus the interest minus that the part you paid 50,000 pounds, which is calculated by 89.12 plus interest, which is 7.13, okay, minus 50,000 pounds. So the opening liability at the second year should be equals to minus 50 wait the opening liability at the second year is equal to 46.25, okay, and during the second year this part of asset will generate interest, right? So the interest generated in the second year is equal to 46.25 times 0.08 is equal to 3.7 thousand pounds, and at the closing date, like at the date, let's imagine at the date of 31st December, what is the closing balance of liability? Anyone tells me. What is the closing balance of liability? It's equal to 46.25 plus 3.7, right? So it's approximately equals to 50. And at the opening date, because at the third year, you make the payment 50,000, and it's equal to the lefty part of liability. So this transaction has finished, and the balance sheet is balanced. So therefore, by calculate the liability accounts and the interest and the repayment, we know that the total interest for 2022 is equal to 3,703. Okay. And Dr. Gabriel said that this question you have been revised once, and before the revising, the correct answer should be 7,000 something, 7,133. Okay, but I don't know what is a revisement you made in this question. And even after revisement, we all use same method like we just did to calculate the correct answer. Okay, the only thing you need to remember is how to calculate the opening liability. The opening liability is basically equal to the present value of this leasing contract. Okay, and for question 24, Star Wars Ltd. Leases Kingdom Ltd. Leases equipment worth 600,000 at fair market value under a finance lease. The contract is for a 5-year period with annual lease payment amount to 150,000 pounds. Blah blah blah. Depreciated over 8-year period. Based on this information, total payment of this lease and book value of this equipment at the end of year 5. So the total payment is equal to 5 times the annual lease payment and plus at the end of lease, okay, the purchase is option, and therefore the total payment is equal to the 760,000, and because the overall life of this assets is 8-year period, so by calculation the depreciation with straight-line method, you can got the book value of year 5 is 225,000 pounds. Okay, and 25 is also important, but basically it's the same question with we have just solved 23. You know, calculate the right of use assets. In accounting, it's called of right of use assets, or like initial liability, or in corporate finance, you can call it present value of these assets. It's equal to 139,000 pounds. Okay. Do you have any do you have any question in this multiple choices questions? Do you still have any questions left? Anyone? Because we have 10 minutes left. If you have like specific questions unsolved, we can help you to discuss it. No problem. Okay, fine. So that will be all for today. Thank you for coming, guys. Bye.